Hey everyone, welcome back to the channel. In this video, we're going to be talking about the stock market crash that has started really since the beginning of this year. What I'm going to do in this video is talk about why stocks are falling, what type of stocks are being hit the most, and what, if anything, will stop this crash from continuing. So if we take a quick look at the S&P 500 through the SPY ETF, it's clear that stocks have been doing very poorly to start off this year. The SPY started off at almost 480 and we fell as low as almost 420. So that's a pretty significant drop in just a month. Now, if we look at the NASDAQ, which is the QQQ, that has performed even worse than the S&P 500. Again, as you can see here from the chart, it has fallen significantly this year. And the stocks that have been hit the most in 2022 so far are the high valuation speculative stocks, the stocks that have extremely high PEs or no PEs at all because they're not making any money and are trading at crazy valuations of sales. These are the stocks that have been hit the hardest. And if we take a look at a group of these stocks, we can use something like Cathie Wood's fund, ARK Innovation, as sort of a proxy for what these kind of companies are doing. So if we look at the ARK Innovation ETF, this has just gotten clobbered really since November of last year, falling just above 50%. And so I'm sure a lot of people are feeling the pain from this recent correction. A lot of these stocks that have been absolutely crushed were popular YouTube stocks, and so those stocks have performed very poorly. So what we're going to do now is talk about why this has been happening specifically with this group of stocks, and then we're going to take a look at my portfolio to see how it's been holding up so far in 2022. Now, the biggest catalyst behind this correction so far is what the Federal Reserve has been talking about doing. Inflation has been a hot topic really since 2020, but it has just been recently that the Fed has acknowledged that it's a problem and are preparing to try to combat it. And of course, the classic way that the Fed will combat inflation is through raising interest rates. And so there have been some proposals from the Federal Reserve to have potentially 6 or 7 rate hikes over the next couple of years. These rate hikes are going to be small, only around 25 basis points each, but the market is reacting poorly to this news. Again, not really a surprise since extremely low interest rates are what are driving these insane valuations largely in the first place. And so here's a statistic: 46% of the NASDAQ stocks are down at least 50% from their 52-week highs. And obviously, these are the stocks that have been slammed as investors model in lower than expected future returns due to rising rates. And this makes a lot of sense. The reason that a lot of these companies that aren't making money are being valued so highly is because there's not really an opportunity cost to waiting until these companies can potentially make money down the line. If interest rates are at 0%, the opportunity cost of holding a money-losing company for 10 years doesn't seem that high. But once interest rates start to inch up, and once they get to 1, 2, 3%, investors now have to weigh the trade-off of holding a money-losing company for an extended period of time or being able to having a yield on a risk-free return, like a treasury bond. And here's another news article. The Fed officials make it clear this time is different. So this is them saying that they're really going to go through with the taper and these rate hikes, even though there's some speculation that they won't go through with it if the stock market continues to do poorly. I tend to agree with that. I think it's going to be extremely hard for the Fed to actually follow through and raise rates, potentially all the way up to 2%. In 2018, the same thing happened. They started to raise rates, the market crashed, and then they completely reversed course and lowered rates back down. I think something similar to that is likely to happen now, because if they couldn't even raise rates back in 2018, how would they be able to do it now when we have so much more debt and the economy is just so much more leveraged and so much more sensitive to any interest rate fluctuation? So what I think is going to happen is, if the Fed keeps talking about rate hikes, and even if they actually do hike rates a couple of times, I think the market's going to continue to fall and the Fed will eventually have no choice but to reverse course and drop interest rates back down to 0. I really don't see them going through with the rate hikes if it's going to completely crash the economy, which 2% interest rates would actually have the possibility to do. Now, of course, the best way to combat this is to not own extremely high multiple, extremely high valuation stocks. Focus on undervalued companies, and you won't even really be affected by what's happening in the markets as a whole. As a whole, my portfolio has been holding out very well. So we can take a look at a couple of my stocks here. If we take a look at Bank OZK, right, they've been holding up well, trading at just around the same levels as they were at the beginning of 2022. We could take a look at the valuation, trading at 11 times next year's earnings. So obviously not really any concerns about the valuation there. Another company that I own Another company that I own is Cumulus Media. This one has sort of been consolidating in the $10 to $12 range for a while now, not the huge sell-off that you're seeing in other tech stocks. This company is trading at under 5 times next year's earnings. Now we can take a look at another one of my companies, Sprott. Sprott has had a pretty good correction in the past couple of months, but if you take a look at the long-term view, Sprott has been sort of trading in this range between $35 and $45 for the better part of a year now. And so again, I'm not really concerned about this company trading at 17 times next year's earnings. And another one of my big positions, AMR, still trading at just around its highs that it's made recently, trading at 2 times next year's earnings. So again, the point I'm trying to make is if you own these kind of companies that have real earnings and are trading at reasonable valuations, then you really have nothing to worry about even if the Fed does raise rates. I think that's what's important about investing with a margin of safety. You're able to be insulated. You're able to be insulated against events such as this that may have an adverse reaction on the market as a whole. Now, there has been one company that I own that has performed very poorly since I bought in. That is HCI Group. They are down just about 50% since I bought in. And so obviously this is the one company I own that would qualify, that would fit into that basket of high multiple stocks, right? You can see they're trading at around 80 times next year's earnings. Again, I bought this company as a special situation play with the spinoff of one of their subsidiaries. Since I bought in, news came out that the spinoff was going to be delayed. And so that has been what has caused this drop. I'm going to make a full video explaining the situation on this company and why I'm continuing to hold. But overall, I would say my portfolio is holding up pretty well with the exception of HCI, and that the reason for that is due to it, investing in fundamentally good companies at cheap valuations. So that's it for this video. Let me know what you think. Let me know if you own any stocks that have been getting hammered over the first month of this year and what you're planning to do with them. As always, if you found value out of this video, be sure to leave a like and subscribe to the channel if you haven't already. So that's it for now, and I'll see you on the next video.